Welcome to the deep dive video. This is a video that I do once a week where I go through a lot of the charts that I look at and present them in this video because maybe I didn't talk about them all that much in the past week. That's why I call this a deep dive video. We have to look a little bit deeper. We have to really skim underneath the surface to try to find some clues from these other charts. In the daily videos that I do, and even the weekly videos, I try to point out those things that are pretty obvious to us. In this video, we might look at things that are not quite as obvious. This is being prepared for Monday, April 1st. The first chart is a chart that I usually use in the daily video, but you can see over here on the bottom, ever since November, we've been pretty much flatlining. This tries to measure fear. This is similar to the VIX and other fear and greed indexes that we use, and it's not spiking up. It's pretty much showing that there's not a lot of fear in the market. So I've dropped it for the time being from the daily video. So on one hand, this can just confirm what we're seeing in our other fear and greed charts that we look at, is that fear is not very prevalent right now. The market's quite positive. When we get a really low reading like this, sometimes that can mark a bottom. And you can go back and look at other times when we showed not very much fear and then we reversed and went in the other direction. If we start to see that with this chart, I'll be including it again in the daily videos. Another chart that has been helpful in the past, but really hasn't been helpful in 2024, is a ratio between those things that are risk on. That means folks are jumping into stocks and usually riskier stocks, and risk off when they're not in the riskier stocks that tend to do better when we're going up, but worse when we're going down. And when this is going up, we're more in a risk on type of an environment. When it's going down, we're more in a risk off type of environment. Ever since the beginning of 2024, this ratio has been pretty much chopping sideways. So we're not getting any real trends out of it right now as we're seeing the market shift. The whole environment is starting to change over to, rather than a rising interest rate environment, possibly a lowering of interest rates, at least according to the Fed, which will then follow through into the other interest rates. And without any kind of crazy things happening in the economy, that could be quite positive for stocks. But in the meantime, this chart really hasn't been giving us much additional insight. Then this is a chart that's unique just to this video, where we look at the VIX, which is a fear gauge. And I have the VIX on here, but I turn it invisible. Over top of the VIX is a 50-period exponential moving average, and this goes back to 2004. This gives us the long-term range of the VIX. And we really spiked up into a higher range back when we had the great financial crisis. And then as things were getting better, we went back down into a lower range. Then we had the whole COVID plunge. We went back into a higher range, and now we're establishing more of a lower range. The VIX was originally designed to use static numbers. Roughly 12 to the downside and below means that there's just no fear, or that investors are very complacent. And then when we get to 20 or above, that means there's a lot of fear in the market. And you can see here, according to the moving average, that we don't always stay within those nice, neat little ranges. And so since the VIX can be more dynamic and change over a long period of time, that's why I've included this study. We don't really use this to make decisions. This is more for informational purposes. Another thing that sometimes I use in the daily videos is how fast is the VIX moving. And to measure that, we use an RSI based on 9 periods. And we look for extreme positive or negative readings if stocks are really going up or down. Right now, we're below the midpoint as stocks have been going up because the VIX goes down as stocks go up, but we're not getting any kind of an extreme reading. When we do, that's when I start to show this chart in the daily videos. Then this is something we were watching for a while. This is a correlation between the VIX, the fear gauge, and the S&P 500. When we get above this dashed line, that means the market's getting quite nervous. Now, sometimes this can mark a top, sometimes a bottom, sometimes just a continuation. Typically with this chart, when we get a very high reading, that can quite often mean that the market's getting quite nervous and we're looking at possibly a pullback at this point. Well, right now, we're really coming down with this correlation, and so we're not getting any additional insight from this chart. Then we look at a thing called the move index, which hasn't been around all that long, just a few years. So doing historical research on this has been pretty difficult because there's just not data to go on. So I have to kind of test this in real time. This measures the volatility of bonds. When this is going down, that typically means that bonds are going up and showing less volatility. Just like with the VIX, which measures the volatility of stocks. When this is going down, that means there's not a lot of fear in the stock market. Then I have a study down here in the middle. The green line is the VIX minus the move index, just to give us an idea of what's happening overall. And when this is going up, that means that stocks are more volatile than bonds. And then what I really focus in on is the correlation at the bottom. This means that the top chart, the move index and the VIX are having a strong correlated relationship. So they're tending to go in the same direction at the same time. Now that can be up or down. Right now it's down, but if they both turn and start to go lower, then this correlation would still stay pretty strong. This is a thing that I've been keeping an eye on, but I haven't been including it in the videos. This is a ratio between stocks and bonds. When this is going up, and I mainly follow the red moving average here, this just means that stocks are more volatile than bonds. Now, the VIX has been going down for stocks, but when you compare stocks and bonds, bonds do have a tendency to be more volatile. When this is going down, that tends to be more positive for stocks. When this is going up, that causes us a little bit of a concern. We are seeing this going up right now, even though the market is hitting all-time highs. So we want to keep an eye on this to see if this basic trend continues. Here's another fear gauge, which really hasn't helped us all that much in 2024. When this is going up, fear is increasing. When this is going down, fear is decreasing. It's pretty much been chopping sideways since the beginning of the year. This is a gauge that we also use to measure fear, and it's really been declining, showing that fear is really dropping off. But my personal take is that we've been getting enough confirmation from some of the other charts that we look at, so I haven't been including this one. Then just to keep an idea of where we're at as far as are we above the previous all-time highs set back in early 2022? And yes, we are. We're setting all-time highs with the S&P. And as of Thursday's close, since the market was closed on Friday, we're up over 9.04% from the previous all-time high, just for information. Then Stock Charts has a thing called technical alerts. And we did have a shortened week this past week, and a lot of things were happening in Canada. You can see TSX, that's the Canadian index. And when we see a lot of blue or green, that's positive. When we see red, that's negative. And the market is really chopping sideways right now. We do have more of an upward bias. We're not really seeing any selling going on into strength. So we see some positive signals here. But this list is pretty short for the whole week since the market was really not moving all that much. Then Stock Charts has another tool called an index technical score feature. Now you can also apply this to individual stocks or sectors or what have you. I use it as it applies to indexes. Everything I do, the foundation, the benchmark of what I analyze and all the strategies that I implement are all based around the S&P 500. But I still look at other indexes, and I want to know how is the S&P performing in relation to other indexes. StockCharts.com takes different technical indicators and puts them together and gives them a score from 0 being the lowest up to 100 being the highest. Then I look at 5 different indexes. Of course, the S&P, because that's my main focus. I look at the Dow. I look at the NASDAQ 100. I look at the mid caps and the small caps. And then I rank them from the best looking chart down to the worst looking chart. Coming in first place is an area that kind of since the end of January has been a stronger area, are the mid caps coming in at 85.3. They've been setting all-time highs with the index. It's the small caps that are really lagging behind, but this area has been showing a lot of strength lately. In second place is the S&P 500 coming in at 79.2, and this is a broader benchmark. This is one of the reasons why I focus on the S&P. It has growth. It has the Magnificent Seven in there, but it also has value companies as well. So you get more of a diversified look at the stock market by using the S&P 500. Then coming in third place are the QQQs, which for most of 2023 and even into 2024, that have been doing the best. Well, recently they've been taking a bit of a breather as the Magnificent Seven have been pulling back, and other big stocks that make up the QQQ are either going sideways, if not actually declining a little bit. So they're in third place right now at 75.7. Then we have the small caps, which came off having a good week. They were up 2.5% for the week, and they're coming in at 69.2. And then now last place, which at sometimes we see the Dow, the diamonds here is represented by the ETF, that has been coming in first place, or at least second, possibly third, but now it's coming in last place at 66.1. Then we look at some short-term charts. This first one is what I call a short-term rainbow. The reason why it's short-term is we use shorter-term moving averages here, from 10 periods up to 50 periods, and all of the lines are going up and prices above all the lines. So this means that the short-term trend is decidedly positive. Then I look at a 20-period double and triple exponential moving average study here. And the takeaway from this is we're seeing the green line and the blue line kind of coming together as things have been slowing down a little bit. The blue line, which is the triple exponential moving average, it moves faster. And so when we're really going up, the blue line will be above the green line, but we're seeing them coming together. But when you look at both of them, price is actually above both of these moving averages, also confirming that the short-term trend is positive. Then we look at some intermediate term charts, and this is another rainbow using further out moving averages from 50 periods up to 100 periods. And here we can see that all of the lines in the moving averages are going higher and prices above all of the lines. We closed at an all-time high on Thursday with the S&P. So the intermediate term trend is still comfortably positive. Then I use this chart, not because I'm focusing on it right now, mainly just to explain this. For decades, we just had a thing called moving averages, where you start right now and then you look back 10, 20, 50, 100, 200 periods ago to come up with what is the average price over those periods. And that can be useful for measuring the trend. If the moving average is going up, we're in an uptrend. If it's going down, we're in a downtrend. You can also use crossovers. So when a shorter moving average crosses over a longer moving average, that can signal a change in the trend. Well, then we have this thing called an anchored moving average, where instead of calculating backwards, what we do is we go back to some kind of a significant point, and then the anchored moving average actually moves forward from there. And we hit this back in October. This was some pretty significant support when we were really going down. Well, we were able to bounce up off of that, and we're quite a ways above this. And this anchored moving average goes back to this previous all-time high. And if we start to really see a decline or a pullback and set some kind of a high, then I'll probably adjust this chart and see if it becomes useful. I also have a couple of other anchored moving averages going back to the COVID lows. We're still well above them. And you can see all these lines themselves are going up. So that's just suggesting that things are positive. We have a Connors RSI, which is another momentum oscillator that we use. And on a day in and day out basis, sorry, I have to clear my throat. This really moves around quite a bit. But when we find some use in this indicator is when we get an extreme positive or negative reading. We're not getting that now, so I haven't been showing this chart. Then I take another double and triple exponential moving average study. This is based on 50 periods. And when the red line, which is the triple, is above the blue line, that means the trend is pretty strong in the intermediate term. We're right in between the red and blue line right now, but everything is still going up and looking positive for right now. If we see some weakness coming into the market, we would see these lines start to roll over and price drop below both of the lines. If the red line drops below the blue line, that could turn things more negative, but that's just what might happen. All we can do right now is look at what is actually happening. Then we do a 50-period moving average study where I plot both a simple and an exponential moving average. A simple moving average takes all 50 periods and treats them the same. or an exponential moving average weights it more towards current prices. You could call this a weighted moving average. And there's the debate that goes back and forth, which one is best. So there are positives and negatives to both of these. I ended up just having a chart here where I plot them both. And we can get some clues from this. When the blue line, which is the exponential moving average, is above the red line, the exponential moving average moves faster because it's more weighted towards recent prices. And that means we're seeing a real strong move. And they are pretty much on top of each other right now, and prices above both of the moving averages. So this is another intermediate term trend indicator that we use to show that we are looking quite positive now. And we also do the same thing with a 100 period moving average. This is more intermediate to somewhat long term, and the red line is above the green line, showing solid upward moves, and price is above the moving averages. So that's also suggesting this trend is positive. Then we take a measurement. How far above or below are we from the 200-day simple moving average? And when we're green, that means we're above the 200-day moving average. And as we're setting all-time highs, this continues to show an improvement. Then we have the composite, CMB composite index, and I was using this in the videos because we were going above this black line. That means we're getting an extreme positive reading. But since then, it's fallen back. It's positive since it's going up, but I really only focus on this chart when we get an extreme positive or negative reading. Then Bollinger Bands, and there's a lot of different ways. John Bollinger developed these, and he has a whole book that explains this. You can look at where are we in reference to the midpoint? Are the lines going up? Are they going down? How far are the lines apart from each other? One indicator that I use is called the percent B. And there's a very small percentage of the time when we close above or below the upper or lower Bollinger Band, but we tend to not stay there for very long. We did have a reading back in March for, I think, 3 days, well, at least 2 days here, where we closed above the upper Bollinger Band, and that's very rare to have that happen. And you notice right after that, we did see a pullback. So when we get this extreme reading, that's a warning sign to us. But right now, we're not getting an extreme reading, and this chart is quite positive because we're above the midpoint's going up, and we're seeing the lines in the Bollinger Bands themselves actually going higher. And we'll look at standard deviation. This doesn't measure direction. This measures speed. How fast is something based on the last 10 periods? And this could be either up or down. And we were getting really low readings overall, but as the market really started to move higher, we saw standard deviation picking up, but it's still just a little bit above its moving average. When this really gets moving, we'll see standard deviation really start to spike up. Since we're not spiking right now, I haven't been showing this chart. Then we want to keep an eye on the S&P 100 versus the S&P 500, and we're seeing a little bit of a shift here, at least recently, where the S&P 500 is actually outperforming the S&P 100. You can see there's a little bit of a negative divergence here, where the S&P is making all-time highs, but we're not coming back and making all-time closing highs with the S&P 100, and we're seeing a little bit of a breather in the big stocks. The S&P 100 are the biggest stocks in the S&P 500, and we're seeing the mega caps start to slow down a little bit, the Magnificent Seven. And so we just want to keep an eye on this as the big boys have been taking a bit of a breather. We're seeing the broad market actually doing better, which could end up being more positive. That just means more stocks are participating in the upward move. Then these are some measurements, and I do these myself, so they're probably not exact. I just like to measure from lows to highs and then pullbacks. We did come down in October and we set a low, and then since that time, we've been bouncing up and setting all-time highs. And according to this, we're just under 22% in the upward move since that time. This is the Pring bottom fisher, which is not really helping us right now. This is helpful when we're really going down and possibly forming some kind of a bottom that we could bounce up out of. Well, since we've been going up, I haven't even really been looking at this chart. The mass index is also not generating a signal right now. When we go above the red dash line and then the blue line and then turn and come back down, that's a signal. Well, currently we're far away from both of those lines. Then a long-term rainbow goes from 50 periods up to 250 periods. This is also showing that the long-term trend is positive. All the lines are going up and it's pretty smooth, and price is above all of the lines. And we have a daily special K chart, and I don't show this chart very often just because we don't get very many signals. We are positive on the daily chart for right now. We're above this moving average. And we look at a weekly chart of the S&P 500 on top and a weekly chart of the German DAX in the middle area, and then we compare the correlation. Now, they both have been going up, so the correlation means that as stocks in Germany are going up, which is the biggest stock market in the EU, the S&P has been going up as well. And sometimes they get in the opposite direction of each other, but right now they're having a tendency to move in the same direction. Then we look at the 10-year yield on top and we subtract the German 10-year yield, and US rates are higher than German rates. That's why we get an answer above this red line. That means it's a positive result. And sometimes, but not right now, we can get some insight as to what's happening with the dollar or the dollar index. When we get up into this blue area, that means that the top chart and the middle chart are having a strong correlated relationship. This is going down and it's almost more of a neutral relationship. If we go down into this red area, that means they're going in opposite directions. But when we're right around the middle part, it's neutral. It's not really telling us anything. And then we have a thing called the Hindenburg Omen indicator, and the perma bears love this thing. We're not seeing a signal on this chart right now. We had a spike up. And the cool thing about this particular chart is that stockcharts.com takes the different parts of a Hindenburg indicator or Omen indicator and puts them together into one indicator. So we don't have to figure all this out ourselves. We can just look at a chart. And you can see other times when we see a spike up, and that's when a signal is triggered here. When now over here on the right-hand side, we're not spiking up at this time. Well, other times when we did, and then you have to see a confirmation spike after that within 20 trading days or roughly 1 month. And then what did the market do after that? And usually we saw some pretty significant downward moves after this was triggered. Well, we did see one in the first part of February triggered, but we never saw a confirmation signal with this indicator. So this is pretty much fallen off the books for right now. Then I look at some different support and resistance. Sometimes I show this chart a lot. Right now, for most of, well, pretty much since October of 2023, I haven't been showing this chart at all. This is an Ichimoku cloud, where really this is just a series of moving averages, and then they're shifted forward, because when we're going up and then we pull back, this area may provide support. When we're going down and we bounce, the cloud may end up providing resistance. We're going up and not even near the cloud right now, so there's been no need to show this chart. And then this is an indicator that I developed decades ago, where it's just a 20-period simple moving average of the open, high, low, close. Very simple to a 20-period moving average. But I'm just using different parts to actually do the calculation. And what this does is this produces a little mini rainbow. And sometimes when we're going up and we pull back, one of these lines may act as support. When we're going down and we bounce, one of these lines may end up acting as resistance. Now, another thing we can take away from this is you look at all the mini rainbow lines, they're all going up and prices above all of the lines. So this is also confirming the shorter term uptrend. And we look at some broad market measures. This is a thing called the Vixen, and you gotta love that name. We have a lot of really crazy data when we look at the bar chart up here. So I mainly focus on the line chart, where we have the VIX that's calculated for the S&P 500. The Vixen is calculated for the NASDAQ 100. And for the most part, this has been going down, showing that fear has been decreasing. And then we look at the QQQs, which is the NASDAQ 100. That's the black chart here. And then we have the TLT, which is the long-term bond ETF. And then we do a correlation down below. And they're pretty much neutral right now, where they're not really going in the same direction, but they're not going in opposite directions currently. Look at the bank ETF, which is starting to break out a little bit. It's been doing quite well, and it's still in a longer-term uptrend. We want to really keep an eye on the regional banking ETF, because that's New York Community Bank is a regional bank, and they came out with some pretty bad news. And we're wondering, okay, is there more bad news to come from other regional banks? And in the process of that happening, we're seeing the regional banking ETF really underperforming the financial sector. If this could get back up and turn back into an uptrend, that would help the regional banking ETF look better. This is just something that we're keeping an eye on for right now. And then we look at the S&P 500 and we compare it to 3 to 7 year bonds based on price. And when we're going up and above the rainbow here, that means the market is anticipating a soft landing. And pretty much since about spring of 2023, that's what the market's been anticipating. There's been times of doubt, and this is by no means certain, but based on the Fed pivoting to more of a dovish stance, based on what stocks have been doing and what interest rates have been doing, this seems valid for right now, that even though we saw some economic weakness, we're not really going into a recession. But that's still to be determined at this point. Something could happen in the economy to change this whole scenario, but we can only guess about that. What we can go with here is what we're actually seeing in this chart, and it's looking pretty positive economically. We look at home construction, which is very sensitive to interest rates, and we compare them to 3 to 7 year bonds, and the home construction ETF is really outperforming interest rates, and this is suggesting that the economy is still looking quite good. We look at the QQQs and also compare them with bonds. They're pulling back a little bit as we're seeing some of the QQQ stocks or the NASDAQ 100 stocks seeing a little bit of profit taking and moving more sideways. But when you look at this longer term, we're still seeing that the NASDAQ 100 is outperforming 3 to 7 year bonds based on price. Then just to get a little international flavor going here, we look at the Eurozone and we compare it to US 3 to 7 year bonds, and the Eurozone is actually looking quite good as well. Then here's a ratio where we have the S&P on top and then staples to tech. And when this is going down, that means that staples are underperforming. And that's what they continue to do, as tech has really been outperforming. But you see here back in 2022, when the market was under pressure, staples were outperforming tech. And in a healthier environment, seeing this ratio go down is what we want to continue to see if we're remaining positive on the market. Then we have a couple of informational rate of change charts. These go back 250 periods, and we are seeing that things are still looking positive. Here's another 250 chart based on the rate of change, where we are right about at this blue line. Now, other times this can mean that we're getting a little too extreme. We could still go above where we're at, but this is an area I drew this line on here just to give us a reference point to say, okay, when we get above this, just be aware that maybe we're going up a little too far too fast. Keeping an eye on bonds, we look at 1 to 3 year bonds and then compare them with 3 to 7 year bonds. When this is going up, that means the interest rates are going up. That means that shorter term bonds are outperforming longer term bonds. And that only makes sense. If we're in a rising interest rate environment, you want to be in shorter term bonds because you can roll them over into the next highest interest rate. Then when we started coming down, that means that longer term bonds are outperforming shorter term bonds, and this ratio goes down. And then we started to rise in 2024. And then this really started to shoot back up after the strong CPI and PPI report came out. But since then, the Fed has met, and Jerome Powell gave a speech on Good Friday, and the Fed is turning much more dovish. And so we're seeing this starting to come back down, meaning that shorter term bonds are starting to underperform longer term bonds. And then this is another look at a similar thing where we go a little further out, where we're looking at 7 to 10 year bonds. And when this is going down, that means longer term bonds are underperforming. And that usually means we're in a rising interest rate environment. Then we hit a bottom in October and started to go back up, and then things got a little cloudy again, so we started to go back down. But now that the Fed is starting to pivot and shift, we're starting to see this ratio go up. If we're going to remain in the same environment that we've been in lately, we want to continue to see this chart going back up. Then we look at the long-term bond ETF and we compare it with the S&P 500. We are seeing an improvement with their long-term correlation, but it's not really strong right now, where for quite a while, this was a really strong relationship. Where in the short term, based on 10 periods, it is getting stronger, where the price of bonds in the long term and the price of stocks are moving more in the same direction. Then we look at the QQQs, which is the NASDAQ 100, and compare it with the long-term bond ETF. And that's pretty much neutral right now when we look at the correlation. And here's the yield curve. We want to keep an eye on this. I mention it in every daily video. We still have the 10 to the 2-year, which has now been inverted for a couple years. We also have the 10 to the 3-month, which has been inverted for, I think, about a year and a half, probably a little longer than that. We're going to be waiting to see if interest rates are going to start to come down. At some point, these yield curves are going to go back to looking normal. And then that's when we start the countdown to see if we are, in fact, going to go into a recession or not. Then we look at TIPS, which are Treasury inflation protected securities. These tend to outperform when we're in a rising interest rate environment. Well, when it looks like interest rates are getting a little bit more under control, then we start to see the TIPS underperforming the 3 to 7-year bonds. Now, lately, we haven't been getting a lot of insight from this. This ratio has been going sideways. It's a little more pronounced when we look at TIPS and then go further out with 7 to 10-year bonds. Where we topped out is the TIPS were really outperforming, and then we hit a top with interest rates and a bottom with stocks. This really started to come down. We've been chopping around lately. If we are in a more interest rate friendly environment, we would likely see this ratio continue to drop. And then we look at 1 to 3 month T-bills, which you could call cash, and we compare it to the 3 to 7-year bond ETF. When this is going up, that just means that cash is outperforming bonds. And that means there's a lot of uncertainty about what's going to happen with interest rates. Then we hit that October period and we started to come down as the market was more confident that interest rates were going to come down. Then we had some strong economic reports that threw all that into doubt. Again, like the previous chart, we would likely see this continue to go down if, in fact, we're in a lowering interest rate environment. Then we compare, this is the soft landing chart here, just suggesting that we're probably going to see a nice move in stocks compared to bonds and not necessarily go into a recession. So I showed that chart earlier. Then at the very end, I have a thing called possible positive scenarios. And I used these heavily back in 2022 because we were going up and down and more in a cyclical bear market at that time. But we would hit a bottom and then bounce up out of that. Well, some of these charts are still helpful no matter what environment we're in. I just kind of group them together here. And I show a lot of these charts in each video that I put out daily, but I don't show all of those charts. And in this video is where I show the rest of these charts. This is the percent of stocks in the S&P 500 that are above, below, or at their 200-day simple moving average. Now, there's another study that's also like this, but this is looking for something a little bit different. We look at this measurement here using it like an oscillator. We look for an extreme positive or negative reading. Also, where are we in relation to the midpoint or the 50 level? We're above it and advancing, and that just suggests that things are positive on a longer term basis and not necessarily extreme right now. Then we take that same basic concept with the S&P and we look at stocks above their 50-period moving average. Also, I have a different kind of study that I show each day in the videos, and we're above the 50 level and we're going up and not getting extreme right now. So this is positive. Then to spread it out a little bit, we look at the mid caps, which also are looking better and not extreme. And then the small caps, which were really lagging behind, but they had a really good week this past week. So they are showing some improvement as well. So this gives us a more broad perspective of what's going on. And then we look at a 19-day exponential moving average of the advanced decline ratio. Advancing just means that volume is going up. Declining means volume is going down. And then we can spread that out over a period of time. We can use this like an oscillator when we get an extreme positive or negative reading, but then we can see the overall climate. When we're above the 0 level, that means we're positive, and that's where we are based on price. We're also above 0 based on volume and not getting an extreme reading currently. And then we look at the S&P 500 on top, and we want to keep an eye on the 2-year Treasury yield. Sometimes when this spikes and then goes down, that will give short to intermediate term support to stocks, but it hasn't really been helping it, so I haven't been showing this chart lately. Thank you. I hope you found this helpful. After this, I will be preparing what I call the what to watch video, Where in the video that you just watched, I talk about those charts that I didn't really cover, that I'm not really showing. Well, the what to watch video, that's where I focus on the charts that I'm really honing in on for right now. So have a very good weekend, and I will talk to you in the next video.